Welcome to Mindset Matters, the official podcast of Oregon Realtors. In this podcast, we dive deep into the secrets of top-performing agents, market trends, strategies, tips, and tricks that will transform and elevate your real estate career to new heights. Follow or subscribe today, and stay tuned for a podcast that's not just about real estate. It's about mastering the mindset for success. Thank you for joining the Oregon Realtors Mindset Matters podcast. Today, we are fortunate to have well-respected and sought-after presenter Noah Blanton. Noah has quite the bio, but I'm going to abbreviate it so we can get moving. Noah is the president of direct operations in Oregon for WFG National Title. In this role, he is responsible for guiding the company through market cycles, growing market share, forecasting customer and consumer behaviors, and retaining and attracting talent in WFG's home market. He has 25 years of transactional real estate experience and holds an MBA in real estate finance. What a nerd.
Yeah.
Noah is a frequent speaker on local real estate trends, the market cycle, interest rate influencers, and topics related to real estate supply and demand dynamics. All right, Noah. You are a very impressive presenter. We've had you a number of times here at the Oregon Realtors, and everyone is very impressed with your presentation. Today, Noah will share his expertise on all things involving the current and projected economic conditions, both broadly and in Oregon. So, Noah, welcome.
Thank you, Jenny.
Let's dive right in. What's
Very
happening
warm
out
welcome.
there?
Oh,
What's
well,
happening? What's happening? Just go. Let it rip. How's the market? Are there homes for sale? Are people in business?
Sure.
Where do you want to start?
Sure. All of those things are happening. And I would say that we're at a really, this is the stupidest thing to say, but I always say it because it's true. We're at a really interesting point in the marketplace. And there's a couple things that have happened, I think, for Oregon specifically. And we can talk about some of the larger metro areas and kind of the different markets across the state. But earlier this year, we saw some data that came through January. We have February's numbers now too, where I think very much from a pricing perspective, we hit our trough last year. And so we can see appreciation, we can see the impact of interest rates, we can see consumers adjusting, we can see the impact on pricing, and now we can see the rebound on pricing as well. The other thing we learned last year that I think is going to be a feature of our market for some period of time, and we can talk a little bit more about the longer cycle that I think we're in, is supply became really, really elastic last year. It could enter and leave the market in a way that I think is going to be something that sticks with us for some time. I think that has to do with 2.5 years of really, we can call them artificially low or just low rates, however you want to categorize it. But that's going to stick with us for a while. And so if I were to sum up the market, I would say, we were talking about this before we started, pricing or velocity, pick which one you want. And
can't have it all.
You can't have it all in this market. But I would say the good news is if we went through a very modest reset, that was last year, and the data bears that out now. We see, and we've not seen a demand ceiling, which is positive.
So when you say a modest reset, are you specifically referring to interest rates? Because our housing supply hasn't changed much, right?
No,
in the last year?
I'm referring specifically to pricing, where we saw a softness in pricing as rates went up and as consumers adjusted their expectation to that. We're through that period of time now. I think we're going on 4 months now of broadly consumers' expectations meet what inflation actually is. There was a period of time when the consumer expected 5%, inflation was 9%. That's not a good period of time.
Got it.
Now they expect 3%. It is 3% or whatever the number is.
So home pricing is staying stable.
Yeah. And now you can go into breaking that down into lots of different categories, but pricing below the median, which is always the most competitive, on average now sells for 100% of asking price.
Wow.
And
are you seeing a lot of multiple offers still?
We're seeing more multiple offers, less than we had seen in the past. But I do think that with the reset of buyer expectations, and there's a caveat here. If you can't qualify, you're not a buyer.
Yeah.
So desire and ability are two different things, which I think is also going to speak to the longer term of this market. Many people have a desire because because housing yourself is not getting less expensive anywhere. In the short term, rentals may become slightly less expensive on the multifamily level, but long term they won't. So I think I think we have to say that desire and ability are two different things. Fine. But as at the moment, we don't have enough supply to meet the desire.
Right.
We haven't even run up against ability yet.
Yeah.
And at some point we might. I was having a chat the other day, and part of the conversation was, I'm not sure we would like the market with 5% or 5.5% interest rates right now. What you're going to get is, I think you're going to get rapid appreciation again, a highly competitive market. I think we know that's maybe not as healthy as we'd like the market to be. We can't have 12 or 15% a year appreciation, or candidly, even 8 or 9 or 10% a year, and have that be sustainable. So, what does the future look like for pricing? And I would say that as much as people don't like this, the only thing holding pricing in check is interest rates. And so I know the Fed gets a lot of pushback for a lot of how they've handled this. It's very easy to look at what they've done, but I wouldn't suppose that they don't know exactly what they're doing as it relates to pricing and real estate, and that they're not happy with it.
But isn't it, and excuse my economic ignorance, isn't it a wash? Because if interest rates are low, prices go up, but it's the same net.
Sure. Yeah. And this is
so what's better?
This is sort of the corner they've backed themselves into. I mean, which one are you going to feel good about now as a consumer? Either a low rate and a purchase at the height of the market, whatever that was, or maybe getting some concession. And I think the one place I would say that there's a lot more flexibility is concession. Pricing may be stable, but inside of those transactions, there is concession. We talk about new construction and kind of the influence that has as
What's the psychology of it all? So buyers, is it better to think, because it feels like buyers always want a bargain. Yeah. I mean, you have to be able to afford what you're buying regardless of what you pay for it. But they feel better if they got a house at $20,000 off list and they'll take a 6% interest rate than it's psychology.
Yeah, I don't know. I suppose there's buyer psychology there. I mean, I think for a buyer today, probably the most important psychological influence is that they've not seen prices come down substantially. So if this is an asset I'm going to invest in and the pricing is relatively stable, and I don't foresee, and many people have said this, by the way, it's not just me, that probably the best time to buy a house was in the last 90 days in this cycle. That may have been where you got the most flexibility. I think new construction will continue to be a bright spot for purchasers because builders will incent very heavily, and we can chat about that.
Yeah, what sort of incentives?
Well, I think that new construction is expensive and it's going to remain expensive. And so the way that builders, I mean, if pricing is stable, the way that new construction is incenting purchases is they're offering really, really attractive buy downs. So I'll tell you a story. One of the nation's largest home builders in their last quarterly earnings report came out and they announced a 220 basis point impairment to their earnings. The margin that they had achieved. And it was largely due to two things. One was, and builders have never had this before, it was the first time I think this has ever happened. This builder owns their own mortgage company and had bought futures in rates, assuming that they were going to offer rates substantially lower than the market was offering. And we went through that 8-week period of time where rates came down by a point and a quarter. They're back up now, but they lost their interest rate hedge and had to take a one-time charge of $65 million on interest rate hedges. So this new risk now that's introduced to the pricing or the profitability of large builders. And then they said something more important in the management discussion portion, which was, we're going to continue to offer rate buy down incentives in the $15,000 to $20,000 range on our homes. And we're going to double down on this and continue to do it, even if interest rates come down, to stay ahead of the market and keep our product competitive and attractive to buyers. So,
but they're making up for it on the price end.
Well, this is the point, is the reason they can offer that is because pricing is relatively stable. They don't have as much competition as they had in the past from regular resellers, or we'll call it the organic market.
Mm-hmm.
And so again, it's sort of like, pick which one you would prefer. As a buyer, would you prefer a $30,000, and the mortgage people can speak to this better than I can, which one's better in the long term. But to the point of psychology, do I like a $30,000 or a $15,000 or $20,000 rate buy down where I now have a 5.5% rate or whatever the number is, or do I want $20,000 off the price? They feel good about it.
And free blinds.
Or,
Yeah.
the model couch, or, but I think from a pricing perspective, that speaks to psychology. Yes, I'm paying a high price, but I'm getting a good rate. This is exactly, I think, the psychology that, if we think about the last cycle, so the last cycle was centered around interest rates as well, and loans for single family borrowers. I think the default rate in the last cycle was maybe 3 to 5%, depending on where you went. It got up into the double digits in some markets. That's what it took to throw the mortgage-backed security market into crisis and flood the country with foreclosures, and our market was flooded with foreclosures as well, and devalue real estate. We'll call it 15 to 25%, depending on where you were at. In some cases, 40%. This cycle, you have exactly the opposite. 22% of all borrowers have a rate below 3% fixed for 30 years. 22%. And the consolation prize for not being able, let's say you couldn't sell your house today. Mm-hmm. The consolation prize is I get to stay in my house for less than the rent on a 2-bedroom apartment. I mean, we've never had a marketplace where your consolation prize for staying was cheaper housing. And I just think we've not fully absorbed what that means for our market in the long term. I think we have sort of institutionalized, or enshrined, I would rather is a better word, housing shortages from an inventory perspective across the entire country. That's true. And so the prize for the market, I guess, as a whole is stable pricing. Yeah. Our market bears that out. The data bears that out. And I don't mean to say that there aren't pockets of, there will always be areas. If you own a condo downtown, that's a different conversation.
So what you're saying, correct me if I'm wrong, last year prices remained stable. You envision this year home prices remaining stable. So what will fluctuate is interest rates. Maybe not a lot, but enough. So if a potential buyer asked you, is it a good time to buy? Should I go ahead and buy? Should I wait 6 months? What would you tell them?
Yeah. So my answer is always the same. The best time to plant a tree was always 3 years ago. So the second best time is today. And if your goal is to buy and sell out of real estate in the next 12 months, it's probably never a great time to buy. And unless you're a professional and you know how to do that. But if you need housing, buying is always the best way, if you can afford it, to provide yourself that housing. And Warren Buffett had an interesting take on it. And I think many people have probably heard this, but he said, essentially, buying a home is a hedge against the dollar, is what it is. And so you buy an asset, you hedge against the dollar. And if the rate goes down, you can always reorganize your rate and lower that rate. And if it goes up, you've hedged against interest rate in the dollar. So it's always a good time to buy real estate. Now, that might be true, or that might not be true if you're looking at different types of real estate.
Like what?
Commercial real estate, excuse me, in certain sectors. Multifamily real estate doesn't always make a lot of sense right now. Certainly different types
of... Can we stop there for a second on the multifamily real estate? Is that because it's in just the cost of a multifamily property, or because you're going to be subject to landlord-tenant laws, or there's a number of factors that could impact
I think both, but I'm speaking primarily to, it just doesn't pencil for the investment that you have to put in. As interest rates have gone up, your cap rates go up. Your project that looked feasible 3 years ago now has to have a rate increase of, rental rate increase of 20% to make it yield the same margin that you want. And the reality is there's other investments that may have less risk, maybe less tax benefit, but less risk, and you can stay more liquid in this market. I mean, you can still buy a 2-year treasury for nearly 5%. So, and the issue with that in this market is, and this wasn't true a year ago, but the issue in this market is inflation, headline inflation is now in the 3s. So now you're at a point where it does make some sense. Those alternative investments are not just safe, they're smart for the amount of risk you're taking. And so we're in this interesting period of time where we're moving from one type of a market to another. And I think there's opportunity in that. And I think the people, back to the question of, is it a good time to buy? The people that bought 3 months ago are happy. I promise you that. And the psychology of rates is 8% looked a lot different on the way up than it did on the way down, didn't it?
Yes.
And there's urgency to act on the way up. And on the way down, people are like, it's going to keep going down. So I'm just going to hang on, and I'll buy when it's, in the 5.75%. But I think if you look at the last 17, 18 weeks in interest rates, what we're going to find is if rates are to fall, and by the way, I'm not entirely convinced that they will, from really their present levels, if they're going to fall, they're going to do it in a zigzag pattern where they go up and down and up and down. And I think if you bought the dip, at 6% or 6.25% or whatever the number was, if you bought the dip, you're pretty happy. If you could pull that trigger, you're pretty happy. And we haven't seen, we're not to the point yet where we've seen large scale refinancing. But the other thing I would say is, if you think about the longer cycle here, where thousands and thousands and thousands of people are going to voluntarily, without moving, reduce their housing costs when rates come down. And that piece is, that will stimulate consumption, which is good for the economy. It will stimulate savings. It will stimulate home repair and other things. But, we're at probably the peak of pricing and interest rates, let's say. So as interest rates come down, we can just kind of you can form up a pretty good vision of this. And I imagine that practitioners see this much more clearly than we do. We see it in theory, they see it in reality in the marketplace, but there just isn't enough inventory to drive prices down.
So what are you seeing from an economist perspective / title company, escrow company? Which sectors in the commercial side are hot and which are not? And I don't want to slam any commercial practitioner who specializes in the not.
Yeah.
But with the interest rates not low, it's not a great incentive for investors to buy, right? Because you can't turn a quick profit.
Yeah. Where I think we have very significant risk that we've not even yet begun to address is in the commercial market. And this is risk, I think, to the banking system in general, to specific banks specifically. But if you look at, warehouse, industrial type, that still does pretty well, especially depending on where you're at. Office is difficult, although there are pockets of office that are doing well. If you get outside of urban core, there are markets that do quite well. Suburban markets where there is less supply, but now more demand. That vacancy in the urban cores is now emptying out to suburban markets. That looks okay. It looks pretty good. Multifamily, I think, has been a bright spot, but is struggling. I think we're about to oversupply the market in multifamily. And this is both locally and nationally, just because there was so much building. A lot of that building built into one market and is now coming to the market or trying to sell or re-leverage themselves in a different market. So there's probably a lot of opportunity there. If you have cash, there's a lot of opportunity.
Referring to conversions, commercial conversions, or projects already started and then we had...
Projects already started. So you've bought in, your pro forma says one thing, your construction loan says one thing, your appraisal coming out of that says another thing. And maybe you're devalued by $2 or $3 million. And not that your cash flow is any different, because it could be exactly the same, but now you got to bring $2 million to the table. Are you going to do it or not?
Well, wouldn't it depend on what's going to happen after you bring the $2 million to the table? Yeah. What's happening with that?
Yeah. There's $1 trillion worth of commercial loans coming due in 2024.
How much?
$1 trillion that needs to reorganize itself. And $1 trillion where valuations are probably materially different. And so there's going to be a lot of decisions made about whether it makes sense. We could take, for instance, Oregon's largest office building, Montgomery Park, which just went back to the bank. In 2019, it financed for $255 million. It went back to the bank, I think 2 weeks ago, with zero bidders for $37 million.
Wow.
That's probably a really extreme example. But at the very high end, companies that own this type of leveraged real estate, we've seen it in San Francisco and New York with multifamily and hotel projects, it's a business decision. And they'll just make that business decision and say, well, this asset no longer makes sense. We'll send it back to the bank and it'll work itself out. But that cost gets passed on. There's probably some fabulous deals in multifamily and office, and there are some opportunity funds that have sprung up acknowledging that. I think the deals, the 20, 30, 40% off deals that existed in single family residential in 08, 9, and 10 now probably exist in the commercial sector. And this is the cycle of the market. There's destruction and creation, and that's probably largely going to take place, I think, in the commercial market.
So it's actually, if you have the funds, it's a good time to take a risk if you can hang on to it for a little bit.
Yeah, I think the technical term is grave dancing.
Grave dancing. That sounds so awful, though.
Well, yeah.
So how does that? So in the commercial market, it's all numbers, business.
Yeah.
On the residential side, it's more emotional.
Yeah.
It's a home.
Yeah.
So how does the interest rates, if they're staying in the 6% range, if you want a home, you're going to have to suck it up because waiting, that waiting may never happen.
Well, I think, yes, I think we'd have to sort of, run that out and say, I'm waiting for what? So I'm going to wait for either interest rates to come down or prices to come down. Ideally, I'd like both of those things to happen. And then I will think it's a great time to come into the market. But I think you have to take the emotion out of it and be able to explain logically why those things are going to happen. That's going to be tough to explain that. Why is pricing going to come down? We don't have enough inventory, and 22% of buyers have a rate below 3%, but the larger number is almost 90% have a rate below 6%. Half have a rate below 4.5%. So there's this massive disincentive the higher rates are
to sell your property.
To sell your property. The disincentive gets larger. I think this is why we see such elastic supply. It can come and leave the market just fine. So as a buyer, you're going to have to say, well, okay, what are the confluence of factors I'm waiting for? Lots of people have the ability to just hold until they get the price they want. That constrains supply. And interest rates, I think there is a lot of unfounded optimism about why interest rates are going to come back down into the 5% range. And I'm not sure we would be happy with the larger economy if they come down into the 5%
Talk
range.
about that. What does that mean for the larger economy?
Well, I think for the larger economy, for rates to come down to that level, we would probably have to see significant harm done to the employment markets and probably significant harm done to GDP. Neither of those things appears, likely in the near term. If you talk about Oregon's economy specifically, we're almost fully employed in the state. There's some softness in the forward looking, which probably has more to do with the world economy and maybe some of our population centers. But at present, we're largely fully employed and look better. When you line us up against 50 states in the rear view 12-month mirror, we look pretty good.
Because every day it feels like there's a new headline. One company after another is laying off thousands of employees going here, thousands. Is there a certain sector where that's happening, or is it overall consumer spending? Why? And maybe it's just me. I gravitate towards the doom and gloom headlines.
Yeah. Our industry likes the doom and gloom. We sort of gravitate towards that. And by the way, there's enough of it. I mean, we can talk about, there are certainly some warning signs. And I think the last 2 years has been tough. The transaction velocity is not there. That's been hard. If you want to look at our industry, there's been a lot of employment destruction in our industry, certainly real estate, financial services. If you look at what some of the large banks have done, as it relates to their mortgage departments, Chase and Wells Fargo, and there's been a lot of destruction in that area. Consumers have held up fairly well thanks to credit cards, which may ultimately have something to say about how we move forward. Tech, I think we've seen some good, some bad there, but it's offset if we look at employment as a ratio of the employment or the available population to be employed that is employed. That might be a different way to look at it. We have retirements and aging population. I think Oregon's going to peak out in retirements actually this year, 2024. That's the state's projection. And so that's also an influencer. In Oregon, we don't have the inbound migration that we used to have.
Right.
So from a fully employed population, if the population isn't growing, that might be a little bit of a false number.
In fact, the net migration has been a decrease in the last year or two.
Well, it depends on who you talk to. So the census would tell you that net migration is a negative. PSU, who I trust a little bit more, would tell you that it's been slightly positive. The real number is probably somewhere in between the two of those. Here's what we would say, for certain, regardless of whose numbers you look at. Multnomah County is losing people. That's true. Rural counties are either not growing as fast as they used to or losing people. Bend is still growing. Washington and Clackamas County are growing. And so largely we could say that's true.
Why? Is there a reason? I understand COVID. People wanted to get out. They didn't have to go into an office. They could work from home. So they wanted space and good internet.
Yeah.
But now we're past COVID.
Yeah.
The offices are still empty.
Yeah.
People have not moved back to the downtown core.
Yeah.
Why are they moving out of the country?
Well, I think there's two things there. One's cultural, which is I was speaking to and looking at some markets elsewhere. If you go to Europe and Asia, the office vacancy rate is back in the single digits. Mm-hmm. Different culture. I think when workers were called back to the office, they came back to the office largely. When that mandate was given, people showed up. Here, I think we've taken it a little bit more liberally. Our vacancy rate is definitely in the double digits in the core urban cores in most cities. And if they're occupied, they're let's call it fractionally occupied to where they're not full utilization. I come in 2 days a week or 3 days a week, or if my boss isn't there, no days a week. And I think there's probably a great shakeout coming there. This great myth of remote work productivity probably has two sides to it. That'll play itself out over a little period of time. But I also think that there's some disincentive to in-migrate into the state. Most people migrate for employment. We're not creating as many jobs as we used to. There's a massive disincentive that we must speak about in Multnomah County to migrate out. Both quality of life, but also taxing. There is no greater disparity in the United States than the contiguous county of Multnomah and Clark County from a taxing perspective. There's no greater disparity in the country. So and by that I mean you can lower your taxes more by moving out of Multnomah County and into Clark County, Washington, more than any other contiguous counties in the country.
Well, and that's not a good incentive to move there.
It's not a good incentive to move there, but it is working. And I think the issue with that for Multnomah County long term, and we don't need to center this on Multnomah County, but it's worth discussing, is
how that impacts the greater economy in the state.
Yes, yeah, and whether businesses would also move. And I think you also then need to look at the type of people that are moving. It is the higher wage earners that have the ability to be mobile and move themselves and still keep their income. So those, there's a lot of reasons for that. Other places in the Bend is growing like crazy. So there's different incentives depending on where you're at.
But doesn't that make Bend, which Bend is very desirable, but doesn't it make it a lot more expensive to move there? So the population that has the higher income are the only ones who really can afford to move there, which creates a whole different issue.
And I think there's a new term called boomerang migration, and we can see this now in the trailing census numbers where the boomerang migration was out of Oregon, let's call it the metro area proper, but we can be more specific in Multnomah County to Maricopa County in Arizona. Mm-hmm. You live through a summer there and boomerang back to Deschutes County. And you can see this migratory pattern where people they're mobile enough to say, I'm going to move to Arizona. That was,
But is that are you talking about people buy a second home in
no,
Arizona?
no.
Or they
I'm talking
think I'm
about.
getting out of Oregon,
Uh-huh.
gonna go move down there. Oh, change my mind,
Yeah,
come back.
it's
And then
120 degrees for 5 months
it's
here.
dry heat, Noah.
Yeah, I know.
Dry heat.
This is what I've been told. But I think, yes, I mean, to an affordability perspective in Bend, that's true. But the people moving there, that's not an issue for them. A lot of cash transactions there. And interestingly, the lowest mortgage delinquency rate in the nation is in Bend.
Is that because they paid cash?
They either paid cash or had large down payments, and
Yeah.
the mortgage payments aren't bothersome for them. I think 0.2% or
So
0.1.
pull out your crystal ball. What is the solution here in Oregon? And I know it'll be different based on the community, but
Yeah.
overall, what do you anticipate and expect for the rest of 2024, especially for members in our industry?
Well, the pendulum swings, and I think that's good news. And so we try policies one way, we modify those policies. I think Oregon and many places in the country are in the process of doing that. Maybe there was some good about some of the policies. Maybe we need to modify some of those. I think we're going to have to make decisions about taxing policy. I have been very vocal. I do not think, and people can argue with me about this, and it's fine. I think statewide rent control was horrible. I don't know that we're going to readdress that. I think Washington's now going to try the same type of thing. I think that's terrible for housing in the long run. But the pendulum swing, I think, is inbound migration. Well, a couple things. Employment has seemed to stabilize. That's good for the state. Inbound migration, I think, is now picking back up. That is positive as well.
Can we back up to one thing you said? Rent control is horrible from your perspective based on an economic.
Yes.
Because then the other side of the argument is, I'm not saying one's right, but it disincentivizes investors to buy rental properties.
What it disincentivizes ultimately is the larger solution to the problem, which is more housing.
Yes.
I think we all agree on that. It disincentivizes that. I do not mean to say that rent control does not help some people.
I hear what you're saying.
Because it does.
It's a distinction.
It'll help 10% of the people that need it. And that feels good. It will not help the other 90% that probably need it. Only, I think, inventory can do that. So
how do we get more inventory?
I think
then everything else will work itself out.
Yeah,
right?
everything else works
more
itself
housing
out.
Supply.
Well, I think we struggle a little bit. We're land constrained in many ways, both geographically and then policy wise. So that's hard to get more land. I think some of the things that the state's done have been good. They've just not taken, and I don't know exactly why just yet. I think infill is positive. I think changing some of the zoning laws to allow a wider range of product to be built in a broader range of neighborhoods is a positive thing overall. I thought that was very good and supportive. I think it's not been taken up as much as I probably would have liked to have seen it. And maybe we would infer from that the incentive for those providing the inventory just isn't strong enough yet, or that they are able to find buyers for different types of product elsewhere. And so the market is telling us that while there's still a need, the incentive for the producers isn't there yet to fill it. I do think as interest rates moderate, fortunately, we are emotional creatures. People will get tired of their home. They will at some point decide, at 5% or 5.5%, I'm going to loosen up here and I'm going to move. I think there will be a change in consumer behavior. This is probably fortunate that consumers don't all look at their homes as investments strictly like, an apartment owner would. And I think we will loosen up there. But I would say this, nationally and for Oregon, I think we all need to sort of understand how to function in and approach a market that is expensive, and finding strategies and ways to make that more affordable is going to require some additional creativity. It's not going to be I can get a 2.5% mortgage and afford whatever I want. That was easy. I think a lot of people think rates are coming down into I've seen forecasts in the 4 and 5% range. I think that would be
But it's much more than interest rates.
Much more.
Is much
Yes.
more. And you touched on it a little
Yeah.
bit, but with no land to build on and no ability for diverse housing being
Yep.
built.
Yep. And those are long-term
Yes.
structural problems that I think we have to look at and say, and in the last market cycle, I think we've got to adjust ourselves to say housing is going to be expensive.
Yes.
Period. It's not just in Oregon. It's in many markets. That is true. And we are going to end up with, and this is concerning, I think we're going to end up with equity-rich existing homeowners that then are able to be mobile across price strata. And first-time home buyers, it's getting harder and harder. And maybe there are some policy solutions to that, first-time grants, home buyer grants, and other things that public policy could support. And probably should. We want people to get their foot on the property ladder, or we're going to have to invent new types of product that is maybe increasingly dense, increasingly small, and change the way that first-time home buyers look at getting on the property ladder. I mean, all of those things have been discussed. What we're not going to do, I don't believe, is make housing somehow magically, quickly affordable and plentiful. And I don't just think there's a confluence of factors that have come together to say, okay, housing is desirable, but it's not getting necessarily more and more affordable.
And that is a very complicated problem to find a solution to, because even with really great incentives for builders, whether it's tax or otherwise, there are people who do not want to live in a 500 square foot downtown condo.
Yep.
They want a piece of property, even a 5,000 square foot lot with a fence and a yard. And
and that property ladder to get there may look different. That first rung may look different than a 3-bedroom, 2-bath and on a 5,000 square foot lot, and it may not. What is in our control and what is not in our control, I think, are important things to focus on. It would take us back to maybe where we started this conversation, which is the best way to inoculate yourself against that is buy as soon as you possibly can.
And get started.
And what you can afford. Get started as soon as possible. I have a 21 and a 23-year-old, and I tell them all the time, the first thing you should do is buy a house.
Yes.
As soon as you possibly can, buy.
Start your portfolio.
Yep. And, my first house was a attached townhome. It was not ultimately what I desired to live in, long term. But it was a fabulous investment.
Do you still have it as a rental?
Unfortunately, no. And if I did, I would be very, very happy. Yep.
Yeah. So I guess to sum it all up, you can't have everything. No. Pick and choose what's most important to you. And there's no time like the present to buy, because interest rates will always go up and they may come down a little. Home prices are hopefully always going to increase. It's just at what rate are they going to increase?
Sure. Yep. I would agree with all of that. Yes. And the variables in between there are the ones that we have to contend with in our industry and that our clients have to. But those points, I think, are still relevant now and maybe more relevant than they were even 3 or 4 years ago.
So the sky is not falling.
No, certainly not. If you're a first-time home buyer trying to get into the market, does it feel difficult and hard? Yeah, it does. And maybe you're looking at it and it doesn't feel great. But I think the overall market, the stability and health of it is something that if we were going to pick which one we want, this is a better option for us. Stable pricing, sellers with options, and no demand ceiling. This is a better alternative for us than what could be.
And you don't foresee a change in that projection, that thought at least in the near future. Let's say 6 months or less.
No. So the one thing not in the next 6 months, and maybe not even this year, the great variable there is employment. So employment will shake up inventory if people lose jobs and are not able or need to downsize or change or move for whatever reason. Employment will change that equation. I just don't think enough. That may be where some inventory comes from, is if we get employment and that begins to change things. We damage employment materially, and we might do that. You look at the rest of the world, we cannot pretend that our economy is going to be divorced from what's happening in the rest of the world. Specifically on the West Coast, we need to be concerned about China. Oregon's connected more to China than a lot of other economies are. We should be concerned about that. That may help on the inventory side. But let's think about this problem from the standpoint of, if my employment is damaged and I need to sell my home, I want to sell into a market where there is demand and pricing is stable, so that I can then leverage the equity in that asset into whatever comes next for me. This looks like a market that would afford that. And so I would say that will also provide some cushion if we do see unemployment damaged materially. And we should expect that it will be at some point.
How bad?
I mean, that's a really good question. I mean, I don't know the answer to that. We're in a really dynamic period of time. I mean, productivity, for one, is going to damage employment. We're on the very beginning of artificial intelligence and what that means to many, many, many industries. It's where a lot of the growth is happening in the marketplace. But I think it probably depends on what happens, in other economies as well. But that's a tough question to answer, because we also have we have an aging population. So from the standpoint of jobs, one in, one out, I mean, we may have a scenario now where the demographics help us not damage it as much as possible. I can tell you, in our industry, we had people hold on 2 or 3 years, 4 years longer than they otherwise wanted to, because the market was hot. They were adding a little extra to their retirement nest egg. They were, but just anecdotally, and we're one company and not representative of a majority, but we do have an aging workforce of people that at some point are going to say, okay, I've worked my extra 2 years. And I have a number of those people, even this year, that are saying, okay, this is it. This is the last year. And then I'm going to leverage out.
So as a company, are you going to replace or downsize?
We'll do both. So in some cases, there are productivity enhancements that make it so that we won't replace in some cases. And then in other cases, we absolutely will need to. And the issue for our industry, maybe this is true for other industries, is it's hard to find good people that are trained with a skill set that's applicable. I mean, we're obviously a highly specialized industry, but it's hard to find people. And
which means you either compromise on quality or you're going to pay a lot more.
You pay more.
Yeah.
It's
a balance.
Like the housing market.
Yes, it's a balance in everything we do. Bottom line, Noah, thank you for your information. Your wealth of knowledge is so impressive and so helpful. I remain positive.
Yeah, I do.
And I think our members and everyone in the industry should, even if we hit some bumps in the road.
Yep, I do too. I think the fundamentals are there for us to remain positive.
Great. That's good to hear. Any parting words?
No.
On a positive note?
I was going to say, I think that's a good parting is, it's been an interesting 36 months, and we've seen some highs, and certainly we've come off of that. But I think those that are really engaged, that are working hard, that are educating the consumer, that are helping them make decisions, they're doing well. I mean, it's a grind, no question about it. But I think
you can make a great living. You just got to work.
Yep, you got to work. Yep. So
great. Thank you, Noah. We'll look forward to having you back. Appreciate your time.
Yep, thank you.